What's up, everybody? Welcome to Heresy Financial. My name is Joe Brown, and today we are going to look at what it would look like if Bitcoin was money. And when I say what if Bitcoin was money, what I'm really talking about is what if Bitcoin was used around the world, or at least in one specific country, as money the same way as any normal currency is today. So in that world, there would be very different realities when you look at things like banking, borrowing, prices. And so we're going to look at what day-to-day life would look like and how it would differ from the current system with fiat currencies that we live in today. And just so you know, everything that we're going to talk about also applies to if the world used gold as money. And I'm not talking about a gold exchange standard or a fractionally reserved gold standard. I'm talking about using gold as money. So what we're talking about today applies to both of those potential realities. Ready? Let's dive in. Okay, so we are looking at a couple of differences and a couple of ways that our world would look different if we lived on a Bitcoin standard and everybody used Bitcoin as money the same way that we use currency as money. So we're not looking at what it would take to get there, because the road to get there, you have to have the value of Bitcoin increase by, a lot for the market capitalization, the wealth that it represents to get to that point where it represents all the, potential growth or wealth that's actually in the world. So the price per Bitcoin in US dollar terms today, it would have to go up by a lot. We're not going to talk about that because it's kind of irrelevant to the discussion. The discussion is, after that point, let's say Bitcoin becomes money, all fiat currencies fail. What would that world look like, and how would day-to-day living look? Well, obviously, number one, the first difference is that all prices would be denominated in sats, right? You would go to buy a burger and it would say, hey, this burger costs 100 sats or 50 sats or whatever. And a sat, there's 100 million sats. A sat is a Satoshi or a Satoshi, and there's 100 million of them in every one Bitcoin. And so just due to the size that a Bitcoin would have to grow to in terms of its value, compared to what the prices of goods and services are, you have to have a much smaller breakdown in order to be able to use that as transactions. So that's number one. That would be the the currency, the unit of account. Now, the second difference would come in with lending. And so when you kind of think about today's lending practices and what credit is and bank credit means to an economic system or to the monetary system, in today's world, debt is actually expansionary to the money supply. So when you go to the bank and you get a mortgage, you're not actually borrowing money that somebody else has in savings, or you're not borrowing money that bank is holding back in reserves. When you borrow money today from a bank, they're actually lending that money into existence at the time of that loan. Not 100% of it. Usually it's about 90% or 95 or 99%, or in the case of extreme situations like during the coronavirus, then the restrictions on how much banks had to hold in reserves, that went away. And so some of it recently might have been 100% monetary creation there for the loan. But essentially, when you borrow, most or all of the money that you're borrowing is actually coming into existence at the time of the loan. Same thing with, credit cards. When you swipe your credit card, there's not like a bank account that credit card is holding, and then they're sending that money to the grocery store for you, and then they're hoping that you pay them back. At the time of your transaction, that dollar comes into existence that it did not exist before. So when you have fiat systems that rely ultimately on a central bank that has the monopoly on monetary creation, you have systems where credit actually creates money. That cannot happen if you have a sound money system where actual gold is money, or in this case, you have Bitcoin as money. You don't have the ability to bring new units of that money into existence, no matter what. So the only way for me to send Bitcoin to you, or you to send Bitcoin to me, is that you actually have that Bitcoin to begin with. You can't just create one out of thin air. This means that what's typically called the business cycle, which is really a debt cycle, almost completely disappears overnight. You cannot have debt cycles where you have booms and busts, because these booms and these busts, what they really are is an economy overall borrowing income from the future to spend now, which creates artificial growth that's borrowed from the future, and that artificial growth and that expansion of the money supply creates distortions, and the price mechanisms get thrown off because there's more purchasing of certain items or goods or assets that wouldn't have been purchased before. So you have an artificial increase in prices that throws off the price discovery system, sends false information and false messages to the economy. That creates a boom, but since it's not based on anything other than debt, which is income borrowed from the future, then ultimately that has to correct itself. That's why it's called a correction. A recession and a depression is the cure for that boom. That bust is the cure for that boom. And so you have this business cycle where every time a large amount of purchasing power or income is borrowed from the future to create a boom, it ultimately ends with a bust where that has to kind of be paid back. So instead of the growth cycle looking something like this, you would have the growth really just look linear. It would be really more of a straight path. Now, here's the caveat with that. You might have certain companies that would try and say, like right now, PayPal and Robinhood, you can buy Bitcoin, you can send Bitcoin, but you can't transfer it to your own wallet. And so you might have systems like that where they basically say, yes, this is Bitcoin and trust us. We actually have Bitcoin for you, but they won't ever allow you access to it. You've had this back in history. These are all, what I'm doing here with Bitcoin is just showing the modern technological application of ancient problems, things that have been going on for thousands of years, normally under gold standards. And so back in the past, you would have goldsmiths or you'd have banks that would say, yes, here, use my paper. I will store the Bitcoin, I will store the gold for you. And here's your receipt. You can come back and get it anytime. And I promise you, I'm holding on to it for you. You just can't get it. And so pretty soon that would spark a run on the bank, and everybody would come and say, demand their gold back. And then they'd realize, hey, most of the time, hey, it's not actually there. And so in those isolated circumstances, you would have like booms and busts locally because they would give you a receipt. They would say, hey, you can come back and get your gold at any time. And then without you knowing, they would lend that gold out to somebody else. And so now in the economy, you have two representations of the same unit of money. You have the receipt, and that's trading between people. Let's say you're buying a sandwich or something like that with it. So that's trading throughout the economy as money, but you also have new money that entered through a loan of that same money that this receipt was supposed to be able to redeem at any time. So you have an expansion of the money supply in the system, and ultimately in the collapse or in the settlement or in the bust or in the liquidation event that inevitably happens, what you have is that the amount of money goes back down to what the amount of money really is. And so you would absolutely have cases like this where you would have companies that would claim to have the Bitcoin that they said they did, and they didn't actually have it, or they would lend it out without you knowing about it. And so there would be cases like this, but all throughout history, these things are isolated and they are local, and all it does is it makes people more basically fearful of institutions doing this, and so the trust level with the ones that can prove that they aren't doing things like this goes up, and it makes the entire system stronger, and it makes that thing a lot less common and a lot more rare and a lot more scarce. Now you might say, okay, if banks can't actually lend money into existence, how does lending happen? And the answer is that lending you would only be able to borrow from somebody, and if they actually had it, and you would only be able to lend something that you actually had to give. And so in order to create debt, in order to create a bond or debt instruments, they're ultimately born out of savings. There would be no such thing as debt that didn't come from somebody's savings. It also means that investment itself, whenever you invest in a company or invest in a startup, if you wanted to start a business, you could do none of those things without first saving, or at least somebody else saving who's borrowing from you. So it turns the entire system into a system that's built on savings rather than built on borrowing. Because when it's built on savings like that and you can't lend money into existence, the cost of money to borrow, it actually goes up. Now, if banks can't lend money into existence, this also means that governments cannot lend money into existence either. And so a lot of people would view this as a very bad thing because they said, hey, if there's a recession or if there's a depression or a crash or something some big major incident, the only way that a government could spend would be, number one, to tax. They'd have to tax in Bitcoin, which is a currency they can't control, or they'd have to borrow in Bitcoin, which is a currency they can't control. We've had governments all throughout history tax people in money they can't control, which is really gold. And when they try and control it through something like clipping or dilution, ultimately that basically spells the end of the empire. And people also start using kind of a black market system of money since they know the government money is no good. And so just like a bank, just like an individual, just like a company, the only way that a government would be able to spend would be to get that from income or from borrowing. So taxes or borrowing, they wouldn't be able to create it into existence. And so if they wanted to have like a war chest that was set aside for dealing with, unexpected circumstances that were, of national crisis level, they would first have to save, or they would have to expect that in a crisis people would have enough money for the government to tax from the people in order to redeploy it back into the economy to help out. And so since that is less likely, you would likely have, governments built on austerity and savings rather than borrowing, and you couldn't have it based on just creation of the money supply. Now, you might be thinking, okay, the system that we live in is inflationary because there's a constant expansion of the money supply that constantly reduces the purchasing power of each existing dollar when new dollars are put into existence. So if we had a completely stable supply of money, Bitcoin, that couldn't be lent into existence, couldn't be printed into existence, would that be a system in which prices were stable? Like when you went to go grocery shopping, would you be buying something and it would be cost the same thing every single time for years on end? Or would it be deflationary? And the D word, man, that's a scary world. What if we lived in a deflationary world? Well, the reality is it would not be stable prices. The reality is that the world would actually be deflationary and sometimes be very deflationary. That's the only way growth actually happens, is that you get more for less. And so instead of getting pay raises every year, people would be lucky to get their pay to stay the same each year. Instead of the number of currency units, the number of monetary units you're getting going up in order to give you a pay raise, it just costs less for you to live every single year. If you delay your spending, that means that next year you'll be able to buy that same thing for cheaper. The prices of goods and services go down over time. Now, why would that happen? Because you have actual growth, you have technology, you have efficiencies, you have economies of scale, you have production techniques increasing, you have all sorts of these things that our technologically advanced world produces that right now is getting soaked up and absorbed through the expansion of the money supply, and it gives all that extra purchasing power to the government. And instead, that would just be shared by everybody who saves units of their currency. Because our world, the natural forces of history for thousands of years, our world is naturally deflationary. Humanity gets more for less. And so the overwhelming force of thousands of years of basically all of human history is one of progress, but it's one of more for less. It's not one of, the growth that we think we experience under an inflationary system. It's one of deflation. It's all of humanity gets more for less. And so if you can barely afford to make ends meet this year with your Bitcoin paycheck, well, next year you will be able to afford to make ends meet. And then the year after that, you'll have a little bit left over. And then you put that into savings, and every year the amount goes up that you're able to save, and the amount of stuff that your savings can purchase actually goes up just naturally because the cost of living decreases. So this creates an incentive in the entire system to have low time preference. It means only spend money on things that are going to have a good rate of growth. You're not incentivized in our current system to deploy your cash into anything as fast as possible as long as it doesn't have a negative return like cash does. In a system with stable money, you don't have to do that. So it incentivizes investments into things that don't burn your cash, just burning it at a slower rate than just regular cash does. You're incentivized to only deploy your savings into investments if there's going to be real growth. So the fact of the matter is that a sound money system, whether it's real gold as money or whether it's Bitcoin as money, a sound money system does a couple of things. Number one, it prevents the boom and bust cycle that you get from the debt cycle, unless, of Unless, of course, it's in very small, isolated, and localized circumstances where you have basically cases of fraud. In which case, when those isolated local examples happen and the rest of the world sees it, it makes the entire system stronger because it makes it, everybody else be more aware of that possibility and avoid that at all costs. And you, as a provider of a service like that, will go to lengths to show, hey, we're not doing anything like this. Number two, it builds a system that is built on savings, which incentivizes low time preference. So spend everything as far in the future as possible and save everything now. And just as a side note, that doesn't mean that kind of like we have a crash because nobody's spending money, because ultimately people will, number one, we've seen through history, we've had deflationary money systems all throughout human history, and that's not the case. People are still going to buy food to eat. People are still going to buy things that they enjoy. They're just not going to rush out and buy as much just because their money is fading away, which means that there's more savings. It's like an individual who at the start of their career, they start making, a lot of money. They buy a nice car, they buy a nice house, they start buying a bunch of toys, some nice watches, and it looks like they're richer than, their counterpart who's making the same amount of money, but just saving it away. And then, maybe when 20 years later, when they both are 20 years older, they're going to look at each other, and the one who's been living high on the hog for 20 years, he's got nothing in savings, so he has to work another 40 years or whatever. But the guy who's been saving every penny and living in a one bedroom apartment and living off of rice and beans, he's saved up enough to invest, and now he can retire early. So ultimately, a system built on savings instead of debt and borrowing and consumption, that system will be a lot more robust, and it will allow a lot more spending from a numbers perspective far further into the future, potentially, theoretically, into perpetually, and so that system would provide a lot more consumption, even though it's smaller percentage and smaller upfront than a system that is built on consumption, because it's constantly consuming and eating up everything that it is producing. And so it would build a system built on savings that encourages a low time preference over a high time preference, which is spending now. And finally, money can't be loaned into existence. And so you don't have banks creating money out of thin air. You don't have governments being able to create money out of thin air. The only way they'd be able to spend money is if they get it through, real borrowing, and that would ultimately come from savings, because the only way you can borrow is from somebody else's savings, and you wouldn't be able to have them. You'd only have the other way the government could spend money is if they tax it. And so if they wanted to have a reserves amount that they could use to deploy in case of emergency, they would have to save it themselves. Finally, it would go back. It would revert our world to the deflationary forces that are natural, that are actually cohesive for our reality, and the fact that we have had technological progress for thousands of years is a fact. It's not going to stop, and it is really something that is not compatible with an inflationary monetary system, and that's why we have so many of these crises, because we have an inflationary monetary system, but we have a deflationary world, and they're at odds with each other. Now, one final bonus, I want to address a myth, the myth of the miser, because there's a concern that if we only have a specific set amount of money in the system, that there would be a small number of people that would be able to kind of corner the market on money and get all the money and hold it in storage and not let anybody else have any of that money, and that they would be able to control everybody, and they would, everybody else would be destitute because nobody could get their hands on money. Now, at first glance, I can kind of see how some people might think this, but if you just think through it a little bit, really that notion goes away pretty quickly, because supply and demand. When the supply of something decreases, that makes the demand for it go up. And so we saw this early on in the coronavirus, I think January, February, right when everybody was starting to kind of go crazy and really want to start buying masks. You had some people who jumped on that trend really early. They purchased as many masks as they could get from manufacturers overseas, put them in storage. They were going to wait like a month and then sell them for 10 times or 20 times the price they bought them for online. And so when they bought up as many as they could, and everybody's buying as many as they can now. And so you have a demand spike, but there's a supply that's being held out of circulation. And so in the same way, now instead of masks, think money. In the same way, if you have a supply of money that's being held out of circulation, what you have is that in the system, that makes the demand or the value of that thing go up. Well, what happens when the value or the demand for money goes up? That means the cost of living of everything else, the cost for things, goes down. The relative value of money compared to everything else will go up. And so as people save, and as people hoard money, and as governments accumulate and stockpile money, and as central banks and institutions, they hoard and save and hold on to cash, what that does is it removes a lot of the money from circulation from the system, and it drastically increases the value of that money compared to all the goods and services. That's one of the reasons why we're seeing such a dramatic price rise in Bitcoin right now compared to everything else, is because a lot of the Bitcoin is being purchased and being just held, and it's being pulled out of circulation. And so the supply of Bitcoins that are being sold onto the market is decreasing. It's basic supply and demand. And so you would have an unnatural, really, an artificial or a temporary deflation. And sometimes those could be big deflationary spikes where the cost of everything goes down a lot because the cost of money or the demand for money goes way high because there's so much money being held out of the system. Well, eventually that money gets spent, right? Eventually a government says, hey, we've got all of this money. We're just sitting on it. We could do X, Y, or Z with this. Eventually a company says, hey, this isn't, earning us any money now because the deflation already happened. And, we can grow our business if we spend it in this way. Eventually, a rich uncle, he's going to die. He's going to leave his money to his heirs, and they're all going to go spend it. And if they don't spend it, if they just try and, instead of just spending it and, wasting it, let's say they try to invest it, and they invest it, well, that money now is going into the system. It's going to somebody else who's running a business who's going to use that money to grow their business. So ultimately, these deflationary shocks from holding back money, that's going to be temporary. And when it's deployed back into the system, that would restore kind of the balance. So you'd see short-term inflation, but it would really just be undoing the temporary deflation that happened from the magnitude of the savings. And so, but it's not a bad thing when that happens, because the cost of living of everybody who is holding on to that money becomes a lot more valuable, and it'll go a lot further because there's less of it in the system. And so there's no concern if there are a lot of people that are holding Bitcoin out of the system. Ultimately, the more that happens, the better for everybody. The more the price of Bitcoin goes up, or the value of Bitcoin goes up relative to the goods and services. And again, same exact thing for gold. What I'm talking about here is a sound money system, but this is what the world would look like if we did get a Bitcoin standard. So thank you so much for watching. I really appreciate it. If you have not jumped on the bandwagon yet and you're ready to take the dive into buying either gold or silver or Bitcoin, I've got all of my resources that I recommend and that I use myself on how to do that linked in the description below. Thank you so much for watching. Have a great day.